what we have discussed last week, we begin to discuss on the valuation. Essentially, we are looking at the share valuation. Can you see my screen?
Yeah, I can see.
Yes.
Yes. Can, Prof.
Thank you.
Nampak,
So
Prof.
right. So we basically share valuation is equal to corporate valuation because essentially the um, corporate value is also called the capitalization value, and market capitalization is equal to share price multiplied by number of shares. So essentially, if we can find the share price, we will be able to find the capitalization value of the market capitalization, and that is the corporate value. So there are several methods that we have discussed last week. The first method is called the dividend discount model, and the dividend discount model is essentially price or share price is equals to dividend multiplied by rate of return minus G, and this is actually divided. This is actually from your note. If you recall what we discussed last week in the notes, yeah, the share price is dividend divided by rate of return, which is the cost of capital minus the growth rate. So okay. Yeah. So R is the rate of return, which is the cost of capital, and G is the stable dividend growth rate, which is the annual dividend growth rate. So we need to take the last year's dividend payment, and then we will also determine the dividend growth over the last 5 or 10 years, and then we will use the dividend growth rate as G, and the cost of capital is R. If you like, we can change this format into annual dividend Okay. So that's the first method. The second method is, of course, the price earning ratio, or the PER. Essentially, this is the earning multiple approach, where we multiply profit per share by the number of years, by the future number. And the future number of years will determine on how confident we are of the market in the future. So it is also called the trailing price earning ratio, where we take the current share price divided by the trailing 12-month EPS. So essentially what we want to use is to use the trailing price earning ratio, and this is calculated by taking the current share price divided by the 12 months. And this is the trailing earning per share, and the trailing earning per share. Months earning per share. So this is correct. Trailing.
That was correct, right? That's supposed to be the PE, trading PE, right?
Yeah. So trading price earning per share, which is equals to current share price divided by 12 months EPS. Okay. Basically, what the share price is equals the earning per share multiplied by price earning ratio. So we will use the this is PER, EPS, and this is PER, and so we use EPS as the trailing 12 months EPS. And right. So this is the normally used the most popular method used in the market. Okay. As a rule of thumb, we will normally use the earning per share approach. There is also another approach called the constant growth model, or also called the Gordon growth model. This is the same thing. The GGM Gordon growth model is essentially the common and upfront optional for the dividend discount model adopted by GGM proponent that there is an endlessness growth of dividend which occur at a constant rate, and therefore this solves the current worth of the unlimited sequence of the coming bonuses. So due to the adoption of the continuous growth amount, since the model adopt the continuous growth rate corporation that have a constant growth rate concerning dividend of its shares. So the constant growth model is simplified in the following manner, where the Gordon growth model, cooperation investment from the idea of endless progress in share. Using the essential rate of return, the model discount back the investment due to the assumptions of the endless in sequences of the dividend per share. There will be constant growth rate that will increase per share due to the assumptions that cooperation will forever exist to pay up the required dividend. However, the idea that there will be a continuity in the growth of the dividend per share makes this model disadvantaged compared to the other model. So this is the model. Actually, the share price is equals to dividend divided by R minus G, where G is the dividend expected growth rate, constant and infinity, and R is the return rate of the company, which is the cost of capital, and D, this is D1, actually is the dividend value for the following year, for next year. Right. Next is the capital asset pricing model. The risk-free within the formulation explains the value that money has concerning time, and the possible asset is a measure of how much risk the investment will appreciate in a collection which is similar to that of the market. So when such stocks are too risky compared to the market value, then it will have a beta, which is larger than 1. So the stockpile beta is increased by the premium risk in the market, and this is the risk-free rate which the investor anticipated from the market. And we add the market risk premium to that of the product of both stock beta and risk-free. This is expected to provide the investor with the necessary assistance that they need to find the value of the required asset. So, capital asset pricing model intend to assess if the investment is equally appreciated after risk and it's time worth concerning money similarly associated with this predicted benefit. The predictable outcome of the formula can be used to deduct the likely bonuses in the addition of the investment increment to the asset. So the formula ERI is expected return of investment, and RF is the risk-free asset or the risk-free rate. The beta 1 is the beta of the investment, and ERM minus RF is the premium of the risk market. So this is capital asset pricing model. The complication is that we need to introduce beta, and we need to include beta in the consideration. Next is the other method is called the other method is called the variable growth model. Variable growth model, also referred to as the dividend growth model, is a dividend valuation approach devised by financial experts and investors to navigate numerous investment options present to allow the change in the growth rate of dividend. It helps the selections of individual equities, which are the best fit for the specific strategy of their portfolio. Estimating the fair value of equity is the particular purpose of the variable growth model. Investor can make comparison of the value with the current share or the unit price after calculations of the fair value. So the comparison will help in determining whether specific equity is underestimated or overestimated. Constant growth as well as zero growth of standard stock model do not permit the shift the increase of the expected rate. So this is the step used in determining the value of the share. First, we determine the cash dividend amount at the end of every year, DT, and it is done in the period of the initial development of the year. The step will require modifying the most current dividend, utilizing the rate of initial growth, for instance, G1, and to determine the value of dividend yearly. So this is the dividend rate. DT equals to DO, which is the current dividend, multiplied by 1 plus G1, which is the initial growth, and multiplied by is the power of T today. So then we calculate the current value of the expected dividend expected in the period of initial growth, and then we determine the value of share at the end of the initial growth period, which is the Pn equals to dn plus 1 divided by Rs minus G2. Rs is the cost of capital. G2 is the growth rate, the constant dividend growth rate. And the present component of value found in step 2 and 3 are then added to find the stock amount, which is the PO. Right. When calculating the variable growth model, assumptions to the rate of dividend distribution for the future growth are made for any given period under consideration. The rise of dividend distribution can rise at a constant rate of growth at variable rate or in perpetuity. So the return rate has several interpretations for different users. The lowest return rate denotes the least amount of asset return and would be accepted by an investor taking for taking the specific position equity. Generally, the minimum rate of return that an investor requires for the risk level associated with the specific investment is the measure of the required rate of return. And the capital cost of the weighted average is equivalent to the required rate of return by the equity value. Right. So that's the fourth method that we discussed last week. And this week we want to go into bond valuation. Essentially, bond is a form of borrowing that the company may issue, and also a form of investment that the company may be holding. Bond can be issued by the company itself, or bond can also be purchased from other companies that issue bond, including government. We can also invest in government bond. We will discuss the concept of valuing bond or fixed income security, and we will distinguish coupon from the non-coupon bond, and describe yield to maturity and yield curve. Bond valuation encompasses the technique that is used to determine the theoretical fair value of a given bond. It consists of calculations of the present value of the future payment of interest of a bond and the value of bond upon its maturity. So this is using the knowledge that we discussed on the capital investment decision, because bond is regarded as an investment, a form of investment that will give two forms of return. One is the annual return in the form of the coupon rate every year, and at the end, at maturity point, we will be paid back the principal amount. Since a bond has a fixed value, fixed par value means value on the certificate, which will be paid back to us. and payment of interest. So an investor will use bond valuation for determining the required rate of return to make investment on the bond worthwhile. Usually, bonds serve as a fundamental aspect of capital market. As such, analysts and investors always seek to develop a proper understanding of how various features of bond will interact to establish their intrinsic value. Though the value of the bond, an investor is capable of determining whether the investment would be suitable for the set portfolio. Bonds have a variant that may include loan stock and loan notes, which government and firm issue as a means to raise finance. So, just like other security and capital investment, the present value of cash flow to be generated represent the fair value of bond, which is theoretical. So, in essence, a discount rate is used for discounting the cash flow to its present value. Bonds serve as a long-term debt security that companies and government entities issue with the aims of raising debt finance. So when investors invest in bond, they receive periodic payments of interest, which is known as the coupon payment. As the investment matures, the investor will receive the face value of the bond and the last coupon payment. And each of the payment that they receive from the bond becomes cash flow for the investor. So bond valuation has a fundamental principle entailing that it has a fair value, which is equals to the summations of present value of the expected cash flow. When valuing bond and fixed income securities, the three steps are involved, and this process are uh, um, as follow. First, we will estimate the cash flow. Then we establish the appropriate rate of interest to discount the cash flow. And then we discount the expected cash flow. Step 1, estimating cash flow. The first step in estimation of cash flow refer to the cash flow refer to that of an investor's estimate to receive in the future after investing in a bond. And investment in bond bring forth two types of cash flow. One is the coupon payment annually during the holding period, and the principal payment at the end, at maturity date. The usual cycle of cash flow of bond will involve the coupon payment, which have regular interval at which they receive based on the bond agreement. While the final coupon and the principal payments are received at maturity. So in some cases, bond may not follow the regular pattern. Due to the unusual or irregular payment, different types of bond can come into play, and one such type is called the zero coupon bond. And zero coupon bond is an interesting has an interesting picture. The coupon payment there are bonds which do not have coupon payment. There is no coupon payment. That means there is no annual interest payment to the holder, and the resultant is there would be crucial for analysis to accurately estimate the cash flow that they seek to value the bond. We'll discuss specifically on the zero coupon bond, because zero coupon bond is also a type of bond that is accepted in Islam, in Islamic finance, where when you invest in a bond, we are just buying a discount price of the bond. For example, if the bond face value is say 1 million, we may be buying it at 70%. So we only pay 700,000. And we pay 700,000 and we have to hold it for 10 years. And at the end of 10 years, at maturity of the bond, we will then surrender back the bond to the issuer, and the issuer will pay us back at the face value, which is 1 million. So we will get back 1 million at the end of 10 years. The question is that a viable investment? So next, step 2, we will establish the appropriate rate of interest to help us in discounting the cash flow. And here involve the rate of interest in the discounting of the cash flow. We need to estimate, after estimating the cash flow for the bond, we determine the relevant interest, and the investor should consider the interest provided in the marketplace as the minimum rate of interest to enhance default free flow of cash. And these are the cash flow that emanate from the debt security and are safe with no chances of default. The central bank of a nation will issue this security, like the US, for example, they issue the bond, and so, or they are issued by the US Treasury Security. Example would be a case in which an investor seeks to invest in bond. If the investor chooses corporate bond, it will means that the higher returns are expected from the corporate bond as opposed to the rate of return which would be obtained from the government bond or treasury security. Main reason for this is the possibility of corporate bond defaulting, while the US security treasury bond will never default. Even though investment in corporate bond involve high risk, higher returns are expected. Step 3 is to discount the expected cash flow. The third step is to discount the expected cash flow. And since value of the expected flow of cash in the future and interest rate are available, determining the present value of such cash flow is vital. Present value the present value entail the amounts that the investor has to invest today to help in generating a specific value in the future. And it is also called the discounted value. However, this present value is based on the particular determinant. One of these is the time of receiving the cash flow or its timing, and another is the determinant. Another determinant is the required rate of interest or discount rate. In this case, the first aspect will involve calculations of the present value of each of the cash flow that are expected, and after that, present value will be added, and the sum will give the value of the bond. So what we do is we take the face value that we expect to receive at the specific interval or at maturity, and divide that by the discount rate, 1 plus the cost of capital to the power of n. I mean, this is what we calculate in the net present value. And based on this formula, then we will get the present value of the cash flow. Then we will add all these discounted value to give the bond value in total. The bond value may be affected by different factors that include inflation, credit rating. Additionally, features of bond will determine their intrinsic value. Therefore, investor may need to fully understand whatever they are investing in. The risk will be involved as well as the return to expect. The valuing bond will consider every feature to ensure that the present value is accurate, and the present value will help investors and analysts in making informed decision on investment. So back to, we will come back to zero coupon shortly. This is the difference between coupon versus zero coupon. Coupon bond differ from zero coupon based on the payment of interest, which is called the coupon. A coupon bond involves payment of interest to the bondholder, whereas non-coupon bond do not issue payment of interest. So when long-term investor invest in zero coupon bond, 1 second, hello? Okay. Okay. Boleh tak you bagi saya background sikit? Okay. Okay. So when long-term investor invest in zero coupon bond, they gain a variation in the price paid for the bond and the money received at the bond as the bond mature. So the amount is substantial in the sense that the bond with zero coupon would be purchased at a discount that are deep to the face value of the bond. We'll look at some example later. The coupon bond, coupon originally referred to the actual detachable coupon affixed to the bond certificate. Bond with coupons, known as coupon bonds or bearer bonds, are not registered, meaning that the possession of this constitute ownership, which is called the street name. Yeah, street name. Basically, anybody can hold this bond and transact it in the market. So it is like money. It is like money, except that it has a specific maturity date and so on. And to collect an interest payment, the investor has to present the physical coupon. So bond will be issued with the coupon. So every year end, the coupon will be presented to the issuer and they will be paid the amount of interest. So the bearer bond were once common. While they still exist, they have fallen out of favor for two reasons. First, investors whose bond is lost, stolen, or damaged has functionally no recourse or hope to regaining his investment, and so we have to keep this bond certificate and the coupon like cash. Second, the anonymity of the bearer has proven attractive to many laundries. In 1992, for example, U.S. law significantly curtailed the use of the bearer bond, and all Treasury issue bearer bonds are now past maturity. Today, the vast majority of investors and issuers alike will prefer to keep electronic records on bond ownership. Even so, the term coupon has survived to describe the bond nominal yield. Example of this is 1,000 ringgit bond with a coupon of 7%, will pay $70 per year. And typically, this interest payment will be semi-annual. That means every 6 months, meaning investor will receive $35 twice a year. And because bond can be traded before they mature, causing their market value to fluctuate, the current yield, often referred to simply as yield, will diverge from the bond coupon or nominal yield. For example, at issue, the 1,000 bond will describe the above yield 7%. That is its current and nominal value. If the bond later trade for 900 ringgit, then the current yield has risen from 7% to 7.8% because it is now 70 ringgit per annum over 900 ringgit. So the coupon rate, however, does not change since it is a function of the annual payment and the face value, both of which are constant. The coupon rate or the nominal yield is equals to annual payment plus face value of the bond. And the current yield is annual payment divided by the market value of the bond. Though it is selling at 900 ringgit, the bond will be redeemed at the face value of 1,000. So that's the interesting aspect. Okay, zero coupon. The discount bring forth higher return when the bond is long term, such as a type of bond that will lead to higher return compared to the regular or the coupon bond due to the shapes depicted by the yield curve. When the yield curve is normal, then the long-term bond always bring forth higher yield as opposed to the short-term bond. The payment of interest that coupon bond makes occur before the maturity date, hence making them similar to small bond with zero coupon that tend to have an early maturity. As such, the payment reduce the expected return. Precisely, speculators consider the zero coupon bond to be more volatile in comparison to the coupon bond. In essence, they can use such bond to realize huge profit from the price movement that take a short period. So price of zero coupon bond will increase substantially than those of the coupon bond in situation where there is a decline in the interest rate. Since the price of the US Treasury bond responds strongly to the change in interest rate, then the Treasury that deal with the zero coupon bond always prefer to speculate on the interest rate. Due to the volatility of the price of zero coupon corporate bond, this bond can help speculate on the health of the company that issued the bond. So if a company with previous issue of bankruptcy may issue coupon and zero coupon bond with a similar maturity period of 5 years. By the time this bond mature, their market price will have plummeted as the coupon bond will be paying higher interest that are relative to the purchase price. So it will increase, it will create a cushion in case that the company goes bankrupt before the date of maturity. In essence, this differ from the coupon bond that do not have such cushion, tend to face higher risk as well as bring forth more money in the case that the issue does not become bankrupt. So zero coupon bond may be appealing to investors who seek to pass on their wealth to their heirs. If one receive a bond as a gift and the bond sell for 1,000, then it will only use 1,000 of annual gift tax exclusion. However, the recipient will receive an amount that is higher than 1,000 after the maturity of the bond. Unfortunately, the bond holder with zero coupon, some taxes would lead to a decline in the effectiveness of such a strategy. So in the US, bonds with zero coupon tend to create tax liability for payment of interest, even though they they fail to pay periodic interest. As such, it leads to a problem of phantom income for those who hold the bond. The investor may find it difficult to come up with the amount required to pay tax on the income that they receive, and subsequently, it would be a good initiative to hold bonds that do not have coupon payment in tax deferred retirement accounts to prevent payment of tax using the future income. As an alternative, a zero coupon bond that a US government entity issue. And the interest on the principal bond that may comprise of computed interest of the bond will be free from federal taxes, and the bond are not taxed by the state and the local agency. Most of the coupon bonds are long-term, as they do not mature within a short period. Due to the long-term dates of maturity, investors are capable of planning for long-range goal. And this may include payment for college education. Based on the deep discount, investor can consider putting up some little amount that will grow over several years. So investors would also be able to purchase various kind of coupon bond in secondary market, having been issued from a range of sources such as the US Treasury companies, local and state government agency. Since zero coupon bond do not have interest paid until their maturity, there is a significant fluctuation in price compared to the other types of bond. Fluctuation will happen in the market because all bonds are traded just like share in the stock market. Even though there are no payment made until maturity of the bond, the investor might have to incur payment of income tax on the imputed interest every year.
Prof,
Right. Yes.
is it Malaysia also practice the same?
Yes, we have
zero coupon also, we need to pay the tax first.
No. Well, basically, our zero coupon bond is slightly different. There is no tax upfront.
No tax,
Yeah, no tax upfront.
Okay, thanks.
Okay, yield to maturity or yield curve. The yield to maturity YMT entail, it should be YTM. Entail the total return that an investor anticipate on bond upon holding the bond until its maturity, and it is seen as a bond yield in the long term, but annual rate is used to express it. The internal rate of return on investment in bond, if investor hold the bond until maturity, represent the yield in maturity. So the payment schedule operate at a similar rate, and it is similar to the current yield that divide cash inflow annually from the bond by price of such a bond in the market, and hence determine the amounts that will be made when a purchase of bond and hold it for 1 year, for example. However, YTM yield to maturity varies from the current yield, in that the former account for the present value of the future coupon payment of a bond, and from yield to maturity, an investor will earn some interest rate through reinvestment of the coupon payment from the bond at constant rate of interest until the bond reaches its maturity date. So an investor will be aware of the current price of bond and the coupon payment as well as the value of maturity. However, it would be hard to calculate the discount rate directly. If one buy a new bond and plan to keep it to maturity, changing the price, interest rate of the market, as well as the yield will not affect the investor unless they call the bond. They call on the bond. Basically, the bond is redeemed. However, the investor will not have to purchase the bond directly from issuers and holding them until they mature. And in contrast, investor can buy from or sell the bond to other investors on the secondary market. Bond price may be higher or lower compared to the face value of such a bond due to the economic environment as well as the financial status of the issuer. So, for example, if we go back to our present value analysis here. So this is the template that we need. So we can copy this template. Okay. And let's say the capital outlay is how much we pay for the bond. Let's say we pay 10 million. And the revenue, we will not get any revenue if it is zero coupon. And but we will get at the end of year 5. Maybe we get at the end of year 5, which is the year 6. At the beginning of year 6, and we get the value of, say 18 million. Capital outlay 0, and maintenance is not relevant. Total cash flow this is 0, and net cash flow This is 15. This is 10,000. And the discount rate is let's say the discount rate is 8%. Basically, R. Our R is 8%.
So you need to set your R again.
I need to set my R, yeah.
Yeah,
So,
because you did not copy the R from the previous sheet.
yeah. So basically here is age 24, age 24. Right? Yeah, I have to change that. Okay. All right. It's okay. It's 24. Right.
So
So,
the net cash flow, the net cash inflow at the year 6 is correct. That one. Just want to double check.
this one? Yes.
Yes.
No, this is not correct. The net cash inflow is wait, let me correct this one first. So this is actually we'll use this figure. So we will then calculate the net present value is the present value in year 6 and then initial investment. So the net present value is okay. So basically here we say if the discount factor is 8%, then there will be a positive net present value. Yeah, basically we can calculate the yield of the bond, and we'll calculate the yield of the bond by varying the discount rate until this net present value becomes 0. So most likely this will be lower than 8%. Yeah? So we can vary to say 7.5. 7.5. It is still positive. Oh yeah, it's positive. So it's no, it should be higher than 8%. Eh? Let's put at 9%. Still positive. 9.5. Still positive. 9.7. Still positive. 9.9. Still positive. 10%. Still positive. 10.2. Still positive. 10.5. Negative, so it's 10.4, 10.3, 10.28, yes, 10.29, it's almost, so it's 10.295, it's less than that. So it is 294, almost 2935. Yes. Lower than that. 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 Yes, a little bit lower. So it's 27. A little bit higher. 75. Higher. Good. Higher. Good. Higher. Nine. Um, 3. 5. Yes. So that's the exact yield. So if we want to know the yield of the bond, the yield is that. So this is how you evaluate a zero coupon bond. But if your bond is having a coupon, then you will put in the return here in the revenue every year. Let's say if it is 7% coupon, then you will have here 7% multiplied by about 700. Okay, but then the value that you get at the end is just 10,000. So then you see here that the net present value is negative. At 7% is negative because you are getting back only 10,000 at the end of 10 years. That is the face value. Any comment or question? The difference between the zero coupon and the coupon bond. So this is a coupon bond, and we can have another one down here. As the zero coupon. If the zero coupon, that means here is 0, then you will have just the let's say if you are getting 17,000, then this is negative. So you know that at 10, this is not 10%, so we will if we use 9% discount, then we will give you net present value. So basically this is more than 9% coupon bond and zero coupon, right? So basically zero coupon versus coupon bond. Okay, little bit more. When trading bond with various investors, there is the need to consider the price as a vital component, and through the price of a bond, it will be easy to determine the price that the investors would be willing to pay for the bond. The prevailing rates of interest will affect the price paid by investor. So for instance, higher prevailing rates of interest compared to the existing bond issued show that the existing bond will fall. And the reason behind this is the likelihood of the bond to have high coupon rates due to the increase in the interest rate. Interest rate here refer to the OPR. The OPR in Malaysia here we have the OPR, which is the overnight rate, but in the US they just call it interest rate. Yeah? So we must always compare this with the interest rate because the interest rate is our basic cost of fund. As such, the outstanding bond will be less attractive if they cannot be purchased at the lower price. This is what happens to, for example, the Silicon Valley Bank. The Silicon Valley Bank was sitting on a pile of cash because they collected a lot of deposits from the industry, and they are very selective. They were very selective in their investment or in their loan. They are selective in giving loans to the industry, and so they have a lot of money. And what they do is they invested the money in the bond, and the bond was giving a rate that was based on the OPR at the times of issue. So at the time of issue, the interest rate in the US was low, and so the coupon rate was also low. And when the coupon rate was low, then become a problem when the bank increased the interest rate. When the Federal Reserve increased the interest rate, then the price of the bond will drop drastically. Why it dropped drastically is because the yield that the bond is paying is much lower than the current interest rate. So people would prefer to buy new bond that is giving a much higher interest rate. And that was what happened to the Silicon Valley Bank. They sit on an asset which is in the form of bond, government bond, but the interest rate was low. And as a result, the price of the bond is also very low, and their only option is to hold the bond up to maturity and get the return from or get back their investment at the end of maturity. But in the meanwhile, they have to suffer a very low income based on the coupon rate. The outstanding bond will be less attractive if they cannot be purchased at lower price, and the higher rate of interest would mean that the existing bond have low price. So ideally, a decline in the interest rate, which is the Federal Reserve interest rate, make the existing bond to increase in price. When this happened, it works. It would show that investor is capable of selling bond for higher price than the price of purchase, as the investors would pay a premium for the bond that have higher interest payment or the coupon. Of course, yeah, I mean, when the interest rate goes up, investor may have to pay premium to buy the new bond. So the relationship may be expressed when it comes to the yield and price. Yield on the bond show the return that that is expected in the form of annual percentage, and the price of the buyer may affect the percentage. So in case of decline in yield environment that prevails, the price of bond will rise. Various factors may affect the price of bond, and one of these is the financial health of the agency or the company that issued the bond. In essence, this will influence the coupon rate which the bond will be issued with, like the high rate bond that creditworthy organization issue. The creditworthiness of the issuers of bond also affect the price charged on the secondary market. So in case the issuer has a good financial health, then the investor will be able to pay higher amounts due to their confidence with the consumer on their ability to pay the interest on bond and payment off as the maturity matches. However, in case that the issuer suffer from some financial issue, then the investor may become less confident in the person issuing the bond. So when the condition of the business environment are inflationary, the interest rate environment will be higher. Rise in inflation rate will lead to a significant drop in price of bond, since the bond might not be able to pay adequate interest so that it stay ahead of inflation. So a bond with a longer maturity is at risk of being affected by the rapid rate of inflation and would lower the price of the bond. As such, this is one of the reasons why bonds that have long maturity will offer high rate of interest. Such bond will attract buyers who may fear the increasing rate of inflation. Yield, a yield curve plot the interest rate of bond that have an equal quality of credit. However, the maturity dates tends to be deeper, and based on the slope that the yield curve adopt, investor can understand the economic activity being practiced as well as the changes in the interest rate in the future. And yield curve can be used for benchmarking other debt within the market of operation. And this may consist of the rate of mortgage and the lending rate of bank that tend to predict any changes occurring. Any question?
Hi, Prof. I have
Yeah.
question.
Yes.
For example, this bond yield, right? Does
Right.
it have any impact or implication towards the economy downturns? Like for example, we have a recession and things like that. What is the impact towards the interest rate for the bond?
Yes, basically, during recession, if we expect that the market is going for recession, then the bond yield will go down.
I see.
Yeah, because it takes into account inflation and the market and the market surrounding.
So if let's say the bond yield is decreasing, meaning to say that our economy is in the recession?
Yes, in a way. I mean, not necessarily recession, but we are facing a volatile environment.
Okay. So a high bond yields indicate that stability for in the economy, right?
Yes, but better environment. Just like in the US today,
Yes.
the bond yield is high because the
Correct.
interest rate is high, and
Yeah.
they are all very positive about the economy.
I see. Okay. Thank you, Prof.
And as a summary for the discussion, we say that the price of bond with appropriate price can be equated to the present value that the cash flow will have in the future from the bond. So, for example, when we calculated just now, I seems to have lost my here. So basically, if it is a coupon bond, and coupon bond means a bond that will have a separate coupon paying interest every year. And if we buy a coupon bond of 7%, so we pay here, say 10,000, or it can be 10 million. So every year we will get 7% of the 10,000, which is 700 for 5 years. At the end of 5 years, at the maturity of the bond, we will surrender the bond and get cash. Remember, the cash that we are getting at the end of year 5 or beginning of year 6 is no longer worth 10,000. It is only worth 5,500. After we discount it at 10% in this case, 10%. So this actually make the investment not viable, but the 10% or the rate that we will choose here will be our cost of capital, and we normally use the WACC, weighted average cost of capital. So if our weighted average cost of capital is say 9%, then we see that it is not viable because it is negative 4,000. What about 7%? It is still not viable. Maybe 5%. It's not viable. 4%, not viable. 3%, 2%. Wow, this is serious. This is serious because even at 2% weighted average of cost of capital, it is still giving us a negative net present value. Yeah. So
is the coupon received every year for 5 years or 6 years?
5 years.
5 years, but this coupon and maturity after 5 years, right?
At the end of 5 years. So at the end of 5 years is as good as 6 years lah. Even if you put this as 5 years,
if 5 years, the IRR is 7%.
Is it?
If 5 years, at the end of 5 years.
Let's put it at 5 years. So then this year, so here we will have we put another row.
Sorry, it's 7.53.
So this is principal at maturity. So this is at 3 years. So this is 0 now, and this is yeah. So now it is the present value. This is no, let me recalculate this. Okay. So it is positive 2.3 at 2%. So you said at 7%. 7% is 0. Yeah, 7% is 0 because it is a 7%. It is a 7% bond. Yeah, exactly 7%. So if the bond rate is 7%, your cost of capital must not be higher than 7%. This is correct, right? Okay. So if your cost of capital is 6.5%, something wrong. Sorry, this should be 6.5. Then there is a net present value of 2.7. So it is higher than 6.5%. So we need to determine what is the net present value of the bond before we decide to invest. Yeah, because because bond is very easy. It is a fixed coupon bond, so the coupon rate is fixed every year. But in the case of, sorry, this is coupon bond, and this is the and this one is the non-coupon bond, or what was the term that we use?
Zero coupon.
Zero coupon, yes. Zero coupon bond. So in the case of zero coupon bond, it is we need to determine what is our cost of capital. Let's say our cost of capital is 10%. Then we need to make sure that that we will be getting some amount at maturity which is higher than 10,000. But in zero coupon bond, you will be buying here at discount. Okay, and the revenue is fixed at 10,000 because 10,000 is the face value, but your capital outlay will be low. Let's say your capital outlay is at 6,000, then you see that it is still negative. So if your
So can we use back like this is the 5 years so that later we can compare
yes,
with the above?
yes, I will use 5 years. So this is 5 years. So here yes, 6,000.
And then the capital outlay, shall we put 10,000 also to be same as above?
This capital outlay will depend on how much we pay. Yeah.
Yes,
So
yes.
in this case, the varying thing is that the capital outlay. How much capital outlay we have to pay? For example, let me. So the present value
Present value in the 5th year.
in the 5th year, yes, in the 5th year.
Because the wording there is still year 6.
Okay. In year 5, right? So here is okay. So if we are buying it at 6%, sorry, at 6,000, the coupon zero coupon bond with face value of 10,000, then at 10% cost of capital, we still make some net present value. So in that respect, we are so this coupon is, or this bond is actually worth more than 6,000 if our cost of capital is 10%. So we can vary this to become, say, 6,005, and it's negative, so it's 6,002. Yes, maybe it's 6,250. No, 6,220.
6209.21, sir.
6,209.
6209.21.
Okay.
0.21.
Right. All right. Thank you. So basically, that's the value of the bond. If your weighted average cost of capital is at 10%, then you should not buy more than 6,209. So that's how you use this valuation in the decision making.
If let's say based on the zero coupon bond, the
Mhm.
capital outlay, let's say we still, let's say just now is 6,000, and then there is a positive of net present value of 209 ringgit.
Mhm.
So can I mean, if let's say talking about the current present, do I need to use 209 divided by 6,000 equal to 3 point something percent?
No, that's 3 point something% is the excess, not the cost of capital.
The excess
So,
for 5 years.
yeah. So if you want to calculate the IRR, yeah, you in this case, in this, if this is say 6,000, then you have 209. And so you want to know what is the IRR, then you just vary this so that you will get the zero net present value. And
10.76.
9 point
10.76.
Oh, 10.76. So it's 10.76. Yeah, it's still negative. So it's slightly less than that. Slightly less than 10.75. 4.6. Slightly less than that, or slightly more than that. Slightly more than that. Slightly more than that. Yes, slightly more than that. 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 7. Yes, slightly less than that. So it's essentially, this is how you do. Slightly less than that. Yes, almost there. So that's the rate. So that's how you play, eh? Right. Let me.
Prof, I
Yes.
got one question.
Yes.
Okay, let's say in Malaysia the interest return is like 3% something. What is the difference that we need to put on fixed deposit and the coupon bond? What is the difference? Like
Okay.
which one should?
well, the coupon bond, okay, first of all, if the interest rate is 3%, then you need to determine what is your cost of capital. You calculate your weighted average cost of capital. Of course, you need to take into account the current interest rate. Then you need to take into account the risk factor. You need to take into account inflation. And the other factors we discussed always is the suffering. so you decide on what rate you want to discount at. Let's say if your discount is at say 8%, and then you will put here 8%. So once you decide the 8%, then now you want to buy this bond. And when you want to buy this bond, you put here 8%. So then you ask, what will be the coupon rate of the bond? If the coupon rate is less than 8%, then you know that it will be negative. Yeah. If this is only at 7%, let's say at 7.5%, it is negative. Yeah. So basically you will be comparing your weighted average cost of capital with the coupon rate. Only when your coupon rate is 8% that you will have a zero net present value. So then you know that the IRR of this bond is at 8%. Okay? And so if that is if it is a coupon bond, but if it is a zero coupon bond and your weighted average cost of capital is 8%, then here you know that if you will of course negotiate or maybe buy this bond in the market. So you will have to wait at the price when at least it gives that 8% return. In this case, you know that the return is higher than 8% because at 8% it gives the net present value. So if you can buy at 6,000, actually 6,000 is 40% discount. Yeah, because the face value is 10,000. So this is actually 40% discount. So we will put here. So, oh, sorry. This is this is supposed to be
1 minus 40.
minus. Right. So if you want to find the net present value of 0, then you can vary this rate. Maybe 45% is then become bigger. So it is 64%. Sorry, discount rate of 64% is bigger. So it is 35%. Yes, it is 30%. It's 32%. Yes, almost. So it is It is actually 32 point, maybe 32.5 is less than that. Yeah, less than that. It's 32, 31.5 negative 31.8.
32, sir.
32, is it?
Yes, 32.
Okay. 32 is still positive. Still positive, so it must be 31 point something. 31.8. 31.9. At 31.9, it's negative. When it is negative, then it is now you need to buy at less than that, 31.8. Oh, sorry, 31.95. Yes, almost there. So you can buy at the discount of 31.955. Yeah. Then you have a 1.33. Just now was it okay. See? Yes. Yeah, almost there. You can play around with it. So essentially, that's how you do. Your valuations of bond will depend on your cost of capital. And at the higher cost of capital, the coupon rate must be higher. Right.
Sir,
Yes.
may I ask, cost of capital and cost of fund, is it same?
Cost of capital is broader perspective. Cost of capital normally take into account the whole firm, the whole company, but cost of fund can be specific. For example, if you want to start this solar panel project, and you then get the loan from the bank, and the bank, for example, give you 100% funding, then whatever is the bank rate is the cost of fund.
Okay.
Here, the payment made in the form of interest for the bond are known as the coupon payment. For an investors to value the bond that they purchase, they need to be aware of the discount rate, which is the cost of capital. And the bond in bond valuation, the discount rate has a value based on the risk associated with the cash flow. So we need to differentiate between the bond issued by government and bond issued by company. Some companies that are not reputable may be issuing bond, and always they are called as the junk bond. So in the case of junk bond, you may be able to buy at a very heavy discount, even at 60-70% discount. By valuing a bond, an investor will determine the par value of such a bond, and the value of bond will require calculation of present value of the expected payment of coupon of the bond in future. So through bond valuation, investors are capable of figuring out the rate of return that that they will make in the investment, and determine whether it is worthwhile or not. Right. Let me show you the two slides. Did I have a... yeah. What is the name? That's no. Thought yes, this one. Okay. So this is the valuation. Right. So valuation. The one. Is zero coupon. Okay, in the meanwhile, any more questions? Right. So
So,
yes.
yeah, back to the question from our friends just now. You mentioned about when the interest rate of the government or Federal Reserve is put higher and market is confident or positive about it. But the interest rate, isn't it? Eventually, they will eventually increase the cost of fund for the borrowers.
When the Federal Reserve increase the interest, that will of course increase the market cost of fund, and when that increase the market cost of fund, that will also increase the return on the bond. The return on the bond will be based on the market uh, interest rate, which is the OPR, because when the Federal Reserve increase the OPR and the U.S. Treasury want to issue bond, they will have to issue at the based on the OPR rate or the market interest rate. So the bond, the cost of bond will increase as the OPR goes up, and it will come down as the OPR come down. For investor like us, this is
It's good.
it is good and it can be good and it can be bad. For investors like us, when we buy the bond at the low interest period, then our bond will carry a low interest rate. So if we are carrying it now, then we will be earning less interest, and hence, if we want to dispose this bond will be selling at the lower price because the interest rate is low, the return is low. If we are buying the bond at the higher interest rate and suddenly the interest rate come down, it will be good to us because the return on the bond that we are holding is higher than the market interest rate. So we can sell this bond at a higher price.
Yeah, so it is good for investor, but generally it's also not good for the borrowers.
That's right. That's right. Yes.
Right. Yeah. Thank you.
All right, then we will continue next week. Next week we will.
Thank you, sir.
Yes.
So one more question. If the bond do not perform, will it be any bond that will be suddenly, I mean, disappear or gone?
Yes.
Junk
There is a
bond.
lot of junk bond. So
Junk bond.
junk bond is when you buy a bond with a big risk. If the company,
Like what happened in 2008.
yes,
Like what happened in 2008.
yes,
Okay.
Or the mini
when,
bonds in Hong Kong, Asia.
so when you are holding this junk bond, and suddenly the company collapse, then you will lose all your money, because when the company collapse, the company will go for liquidation, and then they will liquidate all the asset, and they will distribute the proceed from the liquidation based on the uh, uh, priority rank of the liability of the companies. So they will give priorities to, for example, the preference shareholders, some suppliers, and then in the end, then the bondholders, and of course, lower than that will be the common shareholders. So you may only get back 5 cents out of the face value of the bond when the company get liquidated, for example. So that's the risk that you are taking. That is why it is always safer to buy government bond, including in Malaysia. If you buy government bond in Malaysia, it is almost considered as 100% safe, because the government will never default. If in case the government collapses in Sri Lanka, the government is still bound to pay by issuing new money. So the government can print cash and pay you. Of course, the worth of the money may be different.